Hello everyone. I hope so you will be fine. So today we are going to discuss study unit 6 and this is the part of corporate finance section and the name of study unit 6 is valuation methods and cost of capital. So we have these topics in the unit number 6. So we have a topic number 1 which is called stock valuation methods which we will cover today. Then we have a topic number 6.2, which is about cost of capital, current cost of capital. Then we have a 6.3, which is cost of capital for new sources. And then we have a 6.4, which is about options and derivatives. So please remember the unit 6 is the part of corporate finance section. And in corporate finance section, we have these unit number 4, 5, 6, 6 we are starting today, 7 and 8. Okay. So these 5 units are called corporate finance section. And this is this corporate finance section is 20% of your exam. So here we go. Let's start now. Okay. So guys, let me explain here first. 6.1 we are discussing because we are going to discuss discuss how to calculate the market value of the stock or how the stocks are valued. Okay, so it is very simple theory because whenever you want to calculate the market value of anything, so simply you have to focus what on the future cash flows related to that investment. So this concept we discussed in the bonds also. Like in the bonds valuation, we discussed if you want to calculate the market value of bonds, so we have to consider the future cash flows associated with the bonds. And in the bonds, future cash flows were interest payments, which we will make as a company for specified period of time, and plus at the end of loan period, we repay the face value. So similar concept we are going to discuss for the stock valuation. So this is also the same point. If you want to calculate the market value of the stock today, so simply you have to consider the future cash flows associated with the stock. So what are the future cash flows which are associated with the stock? So that is the dividend, right? So because if the company issue the stock, obviously company will pay the dividend in perpetuity. Perpetuity means say in infinity. Now if you are the shareholder, you will receive the dividend from the company. If you are selling shares to other investor, so the other investor will receive the dividend, right? But from company point of view, so simply dividend will be paid in the perpetuity or in the infinity. But as we want stock value today, so what we will do, so these future cash flows, we will convert to the present value simply. Okay. So if you have a present value of future cash flows, so that is going to be the market value of the stock. Okay. Now, this is the idea which we are going to use. And for this, the model which we are using that is called dividend discount model because this model simply will discount the dividend or simply it will calculate the present value of dividend. Okay. And we have here four cases. And these four cases you have to remember while you are tackling the question in your exam. So first case is case number one is because we have to calculate present value of future cash flows and that is going to be your market value. So case number one is if the future cash flows, I mean, say the dividend, the case number one, if the company is paying constant amount of dividend from today to infinity. So what does mean by constant amount of dividend? So constant amount of dividend means say, for example, say $2 per share or per stock, you are going to pay dividend and this $2 is fixed for infinity or for perpetuity. Okay. So now it means this is the scenario simply. So you have to read the question very carefully. If in the question it is written that the amount of dividend is constant. Okay, not the dividend is growing at constant rate. No, that is another case. If the amount of dividend is constant from today to infinity and is asking you to calculate what is the market value of the stock today or what is the current market value. Okay, if you have to calculate the current market value or the today's stock price. So then we will apply this formula. So we will apply the same concept. So market value of the stock is equal to present value of future cash flows. And here future cash flows will be your amount of dividend per year. Let's assume it is $2. Okay, so this you will take amount of dividend per year, and then you will divide with the investor's required rate of return. Because this approach so far we are using for common stock evaluation. So here investors required rate of return mean to say the rate of return which is demanded by common stockholders. And it could be given with these names. It could be given with the name of investors required rate of return, or it could be given with the name of cost of equity, or it could be given with the name of discount factor. Okay. So please remember, let's assume discount factor is 10%. Our investors required rate of return is 10%, and amount of dividend per year is $2. So now what you will do? So you will apply this formula. So amount of dividend per year is $2 divided by investors required rate of return. Okay. So this which is 0.10, and if you will solve whatever answer you will get, 2 divided by 0.10. So this will be your market value of stock. Now you are thinking how it is a present value. Yes, actually it is a present value in perpetuity. Because in perpetuity, how we calculate the present value, we always use this formula, future cash flows multiplied by 1 over R. Actually, 1 over R is the perpetuity factor. Okay, but if you will solve this equation, so future cash flows, if you will multiply with the 1, so it will be a future cash flows and divided by R. R stand for investor required rate of return. So it means it is the formula of present value. Okay, so they will not ask you, is it a present value or not? But just as a concept, I'm telling you, it is a present value. Okay, so this formula actually gives you the present value of dividend, okay, which is discounted in perpetuity. So don't forget the case. So now, as I gave you example, for example, now we are assuming, for example, amount of dividend per year which we are paying, that is, let's assume $5. I'm just assuming, and investor required rate of return is 10%. So 10% you will write 0.10. So 5 over 10 or 5 over 0.10. So this will give you how much? $50 market value of the stock. Okay, this is how you will calculate the market value of the common stock if the case is if the company is paying constant amount of dividend from today to infinity, and you are calculating the market value in today's terms are in the current market value. Okay, then we have another case that is it will work another way. Case number 2 I'm discussing now. If a company is paying, okay, dividend with constant growth rate from today to infinity. So what it means, let me give you example. For example, I'm telling you, let's assume we're assuming that our last year dividend, last month's a recent dividend, last dividend was, let's assume, $5. Okay, and it is a decision of the company that this dividend will grow, for example, with 5% or any X percentage you can assume. So $5 is the last dividend, and this will grow with the 4%, but from today to infinity. So then in this scenario, how you will calculate the market value of stock? Again, guys, so you will apply the formula again. It is actually the present value formula, and how you will calculate the present value of this scenario now. Because if it is last dividend is $5 and it will grow at constant rate, okay, which is 4%, it will grow with the 4% per year. So in that scenario, how would you calculate the market value of the stock? So then again, market value of stock will be equal to the present value, and this is the formula of present value if your cash flows are growing in perpetuity. And you have to remember this formula. So what is the formula? So you will take last dividend or recent dividend times, okay, like simply what I'm telling you, we will take last dividend times 1 plus growth. Okay, 1 plus growth mean to say you are adding growth into this dividend. Understood? And we are not taking here raised to power n here, because why not n? Why I don't want to add the growth for nth number of here in this situation? Because this dividend will grow from today to infinity, and number of years are unknown. So that is why dividend will growth will be what? Last year dividend times 1 plus growth. So this is what is the numerator. Okay, so please remember the last year dividend plus 1 plus growth. So this numerator is also called expected dividend per share, or it is also called dividend in 1 year time. Please remember, if in exam question he told you dividend in 1 year time, already he told you, then you will not do this. Then you will not take this way last dividend into 1 plus growth, because last dividend into 1 plus growth is known as dividend in 1 year time. And if in the question he told you dividend in 1 year time, it means he has already added the growth. Okay, then what will be divided? So then what will be the denominator? So the denominator will be investors required rate of return, which can be given with the name of cost of equity, and minus growth rate. Understood? So now let's do the question. So as I have already explained, so current means a last year dividend into 1 plus growth is called expected dividend per share, or dividend in 1 year time. Okay, so now this is how you will work. Let's have a look with the example here. For example here, I'm creating example because this example is case number 3. So just let's create the example here. For example, we have last year dividend $5, and this dividend will grow with, let's assume, 10% per annum, but into infinity. Okay. So now what, and I'm telling you investors required rate of return is, for example, is, let's assume it is 15, okay, percent. And now I'm asking you, what is the market value of stock? So now you have to apply the formula. What was the formula? So market value was equal to last year dividend, which is $5, into 1 plus growth. Growth is how much? 10%. So 0.10. Okay, divided by investor required rate of return, which is 0.10, because it's a 15%. Okay, 0.15, sorry. Okay, 15%. Minus growth. Growth is how much? 0.10. And now you will solve this. So whatever answer you will get on your calculator, so that will be the market value of the stock. Okay, so if you will obviously take this 5 times 1.10, just let me use calculator. So 5 times 1.10, it will be 5.5. Numerator will be 5.5. A denominator is 0.15 minus 0.10, it will be 0.05, right? So divided by 0.05. So this will be $110, and just check the arithmetical accuracy, guys, by using your own calculator. Okay. So this will be the market value of shares today. Now we have a scenario number 3, and see how it is what is the difference here. Scenario case number 3 is, here you want to calculate the value of stock, but not today. Not today. Maybe you want to know what will be the value of stock after 4 years or 5 years or 10 years. So this could also be the scenario. Similar again, dividend discount model we can use to calculate the value of stock in 4 years time, or in 5 years time, or even in 10 years time. So how you will modify the formula? Formula is very simple. So now you will do this way. For example, again, I'll write the formula here first. Market value of stock, because I'm assuming dividend is growing. Okay. So we'll use here last year dividend into 1 plus growth, because now you want to know the value of, for example, stock after 4 years. So now I'll take a raised to power n. N means a 4 years. And then divided by investors required rate of return minus what? Growth. This will be the formula. Only this n you will add here, because previously we were assuming that dividend is growing from today to infinity. Okay, but now I want to know what will be the market value in 4 years time. So it means I will add now growth for 4 years first. Okay, and then we'll see how it will work. I'm showing you actually. Okay, first we will increase the dividend into 4 years. Okay, actually it's not a complete formula. So first we will grow the dividend up to 4 years, and then from there we will apply the normal formula. Okay, sorry, it's my mistake here. So first we will grow the dividend up to 4 years, up to 4 years, and then from there you will follow the perpetuity formula. So here we go. So this is what you will do here. So first of all, let me explain with the help of example. Okay. First, we will grow the dividend up to 4 years. Okay. Please don't forget. So they're saying, let's assume a company recently paid an annual dividend of $10. Okay. Starting next year. So this is the annual dividend of $10. Okay. Recently paid annual dividend of $10. Starting next year, it will implement a 5% yearly dividend growth policy. Okay, they are saying the dividend will grow for 5%. So now they're saying investors require a 12% return. This is the cost of equity. So what is the value of stock in 4 years? So now guys, here you will apply two-step model. Okay, step number one is what? First, you will add the growth in dividend for 4 years only. Okay, and you will apply this formula. So last year dividend into 1 plus growth raised to power n. N will be here 4 years. Okay. So last year dividend is how much? Last year dividend was $10. I'll take $10. Okay. Times 1 plus growth. Growth was how much percentage? 5%. So 0.05 raised to power n is 4. And if I will solve, so this will give me dividend in 4 years time. Dividend at the end of 4 years. Okay. Dividend at the end of 4 years because I have added the growth for 4 years. Okay. Growth for 4 years. So this will give you dividend at the end of year 4. So then what I'll do, once I got the dividend at the end of year 4, so this if you will solve, so this will be how much? 12.16. Now I'll apply the formula in perpetuity. I'll apply the formula in perpetuity. Okay. So now what I'll do, I'll apply now the same formula for the perpetuity with growth. So market value equals, so this dividend which you have already grown for the 4 years, this I'll take dividend 12.16 into 1 plus growth again 0.05 divided by investor required rate of return minus growth. And investor required rate of return is how much? 12%. The question it told you 0.10. And growth is how much? 0.05. And now if you will solve it, so 12.16 into 1 plus growth divided by investor required rate of return minus growth. So this will give you market value of stock. For example, we have a same question now. Now let's assume you want to know what will be the market value, okay, of shares after 7 years. Let's assume not in 4 years, after 7 years now. So how you will change the question now? First, you have to step number one. First, make it the changes here. You will take recent dividend, which was $10, because now I want to calculate for 7 years, right? For 7 years. For 7 years. So I'll take recent dividend into 1 plus growth, which is 0.05 and raised to power, it will be 7. So this will give you amount of dividend in 7 years time. A dividend at the end of 7 years. End of 7 years. So just you will get one answer here, right? So 10 times 1.05 raised to power 7. So you will get that answer. Okay. So whatever answer you got, so just let's see what is the value first, this one. So we can take 10 times 1.05 and raised to power 7. Okay, so dividend, the amount of dividend will be on my calculator. You can check your calculation. So amount of dividend will be how much? 14.07 amount of dividend. Okay, now this I'll take 14.07. Okay, and I'll apply the normal formula. What is the normal formula? Because in 7 years I want to know. So now I'll take a dividend into 1 plus growth divided by investors required rate of return minus growth. So this will be the market value. Okay, so dividend was how much? 14.07, right? 14.07 into 1 plus growth, whatever growth, let's say it is 5%, divided by investor required rate of return 12%, 0.12 minus 0.05. And if you will solve this, so this will be your market value in 7 years time. Okay, guys, I hope so it is clear. Please confirm, is that clear? Now, guys, we are discussing case number 4. Please remember, I have already told you 3 cases, right? And the first case was what? If you want to calculate the market value of stock today and dividend, the amount of dividend is constant, then this is the formula which you will use. Okay, what is the formula? This is the actual formula. Amount of dividend per share divided by investor required rate of return. And second scenario was if your dividend is growing with the constant percentage, but it is growing from today to infinity, and again you want to calculate today's market value or current market value, then you will apply this formula. So last dividend into 1 plus growth divided by investor required rate of return minus growth rate. Okay. And third scenario is if you want to calculate the value of stock for in the future, that what will be the stock value in 4 years or 5 years or 7 years. So let's assume if it is for 4 years, as data is available here. So first we will take the current dividend, then we will add 1 plus growth raised to power n. Okay, so this will give you dividend in 4 years time. And then this dividend we will put into normal formula. We will bring it here. This dividend into 1 plus growth divided by investor required rate of return minus growth. Okay. So this will be your market value stock. And now the fourth scenario. This is called what? Variable dividend growth rate. Okay. What is variable dividend growth rate? So guys, for example, in your exam question, he may tell you that two different growth rates. For example, maybe for first 2, 3 years, growth rate for the dividend is different. And then from after 2 years to onward, or maybe after 3 years to onward, or maybe after 5 years to onward, growth rate is different. So this is what is called variable dividend growth rate. So again, idea is the same. Even dividend is growing with the different rate. So still we will use the same concept so that the market value of the stock will be the present value of future cash flows. And here you will calculate the present values by using just slight different format. Okay. So let's have a look how it is going to work. So please remember here, I'm going to work with this example. With the help of this example, I will explain and I'll create different scenario for the variable dividend growth rate. Okay. So first scenario I'm creating here, first scenario for variable dividend growth rate. First scenario is that we have a two growth rates here, two different growth rates. Okay. For first few years it is different and then it is different. Okay. For example, let's see. Okay. Here I'm just giving example. For example, a company is planning to pay $5 dividend in the first year. Guys, this dividend is already available for the first year. Okay, and you don't need to grow this value for the first year because it is already dividend in 1 year time. Okay, the first year dividend is $5. Then it will grow for the next 2 years with 20% per annum. If it is in the first year, if it is $5, then it will grow for the next 2 years. Next year will be year 2 and 3. Okay, it is growing with the 20% per annum. And after that mean to say, for example, in year one, he already told you dividend is $5. But for year 2 and 3, for next 2 year, it will grow with the 20%. And after that mean to say from year 4 to infinity, because up to 3 years growth is 20%. After that means say year 4 to infinity. Okay. So after that growth rate will be 8%. Now you can see here there are two different growth rates. Okay. Then if investor required rate of return is 12%, so we have to calculate the market value of stock today, not in future, today. So now guys, how you would work here? It is very, very simple. I'm just going to explain here. So how you will calculate the present value in this scenario while you have a two different discount rates, two different growth rates. Sorry. Okay. First, you will write it here years. We have a year one. Okay. Because we have to discount the future cash flows. Don't write year zero. From year one to onward, you will start year 1, 2, 3. Okay. And then from 4 to infinity because he told you the first year dividend is how much? $5 a year. So we'll write it in the first year dividend, which is given $5. I'm writing cash flows. Dividend is cash flows, right? It is your cash flows. So the first year it is $5. And then he told you it will grow for next 2 years with 20% per annum. So how you will grow the dividend now? This dividend you will add 20% growth into that. And how you will add? You will take $5 into 1 plus growth. Growth is 0.12. So I can say $5 into 1. If I'll add these two, it will be 1.2. Okay, 20%. So if you will take $5 into 1.2, so this will be $6. It means if you will add 20% growth in this dividend, so it will be $6 in the next year. Then you have to add 20% growth in this amount. So this will be the dividend for next year. For example, for year 3, if this was the year 2 calculation, if I want to do the calculation for year 3, I'll take year 2 dividend into 1 plus growth again. And year 2 dividend is how much? $6. You have just calculated, right? So $6 into 1 plus growth. Growth is how much? 1.20. So $6 into 1.2. So this will be how much? 7.2. So I'll write 7.2 here. Okay. So this is the formula is explained here. Just I'm showing one time here. So if I want to calculate year 2 amount of dividend, year 2, I'll take first year dividend into 1 plus growth. If I want to calculate third year dividend, I'll take second year dividend into 1 plus growth. And if I want to calculate fourth year dividend, I'll take third year dividend into 1 plus growth. Understood? I hope so it is clear, right? So this is what it says. So this is for year 2, this is for year actually I have just explained the formula. Maybe here just numbers are written bit. So you have to calculate for year 2 amount of dividend 6 and for year 3 amount of dividend 7.2. Okay. So and for year 4 if you want I will take third year dividend which is 7.2 into 1 plus growth. So it will become 7.78. So this I'll show you later. Okay. Just ignore the last line because in the last line growth rate is different. Or you can do here similar way. You can just simply say, for example, if I want to calculate the year 2 dividend, I'll take year 2 dividend I'm calculating. I'll take first year dividend, which was $5. And into 1 plus growth, it will be $6. And I have shown you here also. Okay. And now, for example, if I want, I'll apply this formula here. For example, if I want year 3 dividend now, I'll take year 3. For year 3, I'll take year 2 dividend, which is $6 into 1 plus growth, which is 2. So 1.2. So 6 into 1.2, so it will be how much? 7.2. For example, and then I want, for example, I want dividend for year 4 to infinity. Because in the question he told you, after that growth rate is 8%. So what I'll do, I want now dividend for year 4 to infinity. For year 4 to infinity, I will take year 3 dividend into 1 plus growth. And year 3 dividend was how much? 7.2. 7.2, right? Here. Into 1 plus growth. Growth is how much? Now 8%, 0.8. So this will give you amount of dividend, which will be, okay, which will be whatever if you will solve here, okay? 7.2 into 1.8. So this will be the amount of dividend for year 4 to onward. Okay, so this will be this amount 7.78. But coming back to the main point, don't confuse it. I was just explaining you how to add the growth. So let me just quickly refresh here because you shouldn't make any mistake. It's really important thing. I was just explaining how to add the growth. So guys, first year dividend you are provided with $5 here. And for second year you added 20% growth. And third year you added again 20% growth. And now it's over till here. And from the year 4 to infinity, in year 4 to infinity, dividend is growing with the 8% rate. Please remember, guys, this is from year 4 to infinity. This is called delayed perpetuity. It is called delayed perpetuity, delayed infinity, right? Because from year to 4, so this dividend will grow with the 8% rate. Okay, so now you will apply, it's a delayed perpetuity formula. And when you apply the delayed perpetuity formula, so this is the formula to calculate the present value of delayed perpetuity. What's the formula? So formula I'm writing here, it is explained here. For the delayed perpetuity, if dividend is growing, so I'll take last year dividend into 1 plus growth rate divided by investors required rate of return minus growth rate. So this is the normal formula you studied already. Just simply what you will do, you will multiply here with the present value factor of the last year. Okay, so then you will get the present value. Okay. Here dividend is growing from year 4 to infinity. It means in year 4 to infinity, I'll apply this complete formula. What is the complete formula? So I'll take last year dividend because I'm applying this formula from year 4 to infinity. I'll take last year dividend, which will be year 3 dividend. Year 3 into 1 plus growth. Growth is 0.8% divided by investor required rate of return minus growth rate into present value factor of last year. Because I'm applying this formula from year 4 to infinity. So last year will be here year 3. Okay, so then I will get the present value. So this is what I'm trying to explain. So here we go. Now, guys, this is what we will do. So first we will write cash flows. It was $5 in year one, $6 in year two, $7.2 in year three, and from year four to infinity, because it's a delayed perpetuity, I'll apply the complete formula. Last year dividend, which will be 7.2 into 1 plus growth, because now growth is 8%, divided by investor required rate of return, which is 12% given in the question. Investor required rate of return 12%, minus growth, which is 0.08, okay, times present value factor of last year. Last year will be year three. That present value factor I need. Okay, that I'm going to show. So here we go. Then, guys, once we wrote this amount of dividend. So what we will do, then we will multiply this amount of dividend, which is your cash flows. We will multiply with the present value factor at 12%. And I hope so you know the present value factor. You will take these factors from $1 table. Just these tables will be available in the question. So this is the present value factor table. Okay, and our cost of capital is 12%. I'll go to the 12%. So this is year one factor. This is year two factor. This is period three factor. Okay, so these factors I'll pick it. So we'll write it here. Year one factor, two factor, third factor. And again, now I'll multiply here. So what I'm going to do, now I'm going to multiply these cash flows with the present value factor and I'll get the present value. So for example, 5 times 0.893, I'll get this present value. This cash flows, I will multiply with this, I'll get this present value. And this cash flows, I'll multiply with this present value factor, I'll get this present value. Okay, but here I have to complete this formula for delayed perpetuity. First I will solve this, so whatever answer I'll get, so then that I'll multiply with the present value factor of the last year. Okay, for example, first I'll solve this area only, this area, so which is last year dividend into 1 plus growth divided by investor required rate of return minus growth. So I got, for example, 194.4, and this figures then I'll multiply with the present value factor of the last year, and the last year is year three here, right? So, and year three present value factor is how much? 0.712. So now this figures I'll multiply with this 0.712, which is the present value factor of last year, and I'll get this is the present value. And now I'll add, this is the present value if I'll multiply these two figures. Okay, so now I'll add all these figures. If I'll add all these figures, so this is going to be my present value of future cash flows. Okay. And if I'll add all these, so this is called present value future cash flows, which will be 152.853, and this is your market value of the stock. Okay, now see guys, here I'm showing you another example and see what is the difference here. Now guys, please remember, just I am assuming here I'm using the same data, and maybe it's the same or different. Let me see first. Okay, no, it's a different data. So now here we go. For example, now, what is the question? They're saying last year dividend. Now, this is the last year dividend because we need dividend from year one to onward. It means now for the year one, we have to grow the dividend, right? Last year dividend is $10 and it will grow with 5% per annum for the 4 years. It means it will grow in year 1, 2, 3, and 4 with which rate? With the 5%. And after that, it will be constant. See, in the previous question, after some time it was growing with the rate of 8%. But now they're saying that no, after 4 years, this dividend will be constant. Now, what will be the change? What will be the change? Now, I'm going to show you what will be the change. Again, investor required rate of return is now 10%. Okay. And we have to calculate stock price today. So how would you work? So first you will write year 1, 2, 3, 4, because for 4 years there is a growth. And after year 4 means a 5 to infinity. So there is no growth. There is no growth. So then how you will work here? So please first just write the dividend. So if I want to write the dividend, which is cash flows, I'll take last year dividend into 1 plus growth. It will be dividend. Growth is, 1 plus 0.05 is the growth, right? 5% for 4 years. So then it will be dividend for first year. Then I'll take first year dividend into again 1 plus growth. It will be dividend for second year. Then I'll take dividend of second year again into 1 plus growth. I'll get dividend for third year. Again, I'll take third year dividend and into 1 plus growth. I'll get the dividend of 4 year. Okay. So I got the dividend, fourth year dividend. This is the first year dividend. second year dividend, third year dividend, and fourth year dividend. Now from year 5 to infinity, because there is no growth. If there is no growth, then you will apply this formula for delayed perpetuity. For delayed perpetuity, you will apply this formula now. See the difference. You will take last year dividend because you are applying this formula from 5 to infinity. So last year dividend will be year 4 dividend divided by investor required rate of return and multiply by present value factor of last year. And see if the dividend was growing. So you were taking last year dividend into 1 plus growth divided by investor required rate of return minus growth times present value factor of the last year. But if dividend is not growing in delayed perpetuity, then you will apply this formula. Okay, last year dividend divided by investor required rate of return multiply by PV factor of the last year. Because in this question, this will be applied now because dividend is not growing from year 5 to infinity. So that is why I'll apply this formula. Last year dividend will be this dividend divided by investor required rate of return 10%. So if I'll solve this figure, so this will give you 121.6. And then this figure I'll multiply with the present value factor of the last year. So now, so we have to write present value factors. So present value factors at 10%. So we'll write at 10% again, you will look into the table from the present value of $1 table, right? This table. Now you will go to the 10%. These are the percentages. Year 1, 2, 3, 4. First, I'll pick these figures and I'll write it here. Okay. So year 1, 2, 3, and fourth year present value factor. And in year 5, I'll also write the same EF present value factor because I have to multiply with the present value factor of the last year. Okay, now I'll multiply cash flows with the discount factor, so I'll get present value. Cash flows with the discount factor, I'll get the present value. Cash flows with the discount factor, I'll get the present value. Cash flows with the discount factor, I'll get the present value. This cash flow with the discount factor, I'll get the present value. Now I'll add all these values. This will give you a total market value, a total present value. I'm saying total present value, which is equal to market value per share. Understood, guys? I hope so it is clear, right? This is how dividend discount model will work. So these are 4 cases I have told you. First case, what if the dividend is constant from today? And then what if dividend is growing from today with the constant rate? Third, how to calculate market value in 4 years time or 5 years time? Okay, and then I told you if you have a 2 variable rate of dividend, sometimes if cash flows first in the first few years dividend is growing with a different rate and then it is growing with a different rate. And then another scenario, like case number 4, I told you if dividend is growing for the first few years with a different rate and after that it is constant only. Okay, so how you will calculate the market value? So the idea is simply we are calculating the present values. I hope so it is clear. Now I'm going to show you some, sorry, we have still for the preferred stock also. Okay, so guys, now we are discussing how to calculate the value of preferred stock. First of all, if you want to decide the issue price of the preferred stock, okay, issue price for the preferred stock, like should we issue the preferred stock at par value or at premium or at discount? So again, idea is very simple. So you are comparing two things. What is the rate of dividend which you are paying and what is the rate of dividend in the market? Right? If a preferred dividend rate, like the if you are paying 5% dividend, but in the market rate prevailing is 4%, it means you are paying more than market rate. Right? So it means today you should receive more than face value. So in this scenario, we will issue the preferred stock at premium. Okay. So just it's maybe sometime as a theoretical question they can ask. Okay, then if whatever dividend rate we are offering, let's say we are offering 5%, but this rate is less than the rate of dividend which is prevailing in the market. Let's say in the market it is 7%. But we will pay only 5%. If you will pay today less, if you will pay less than market rate, then you should receive less than face value. In that scenario, the preferred stock will be issued at discount. But if our rate of dividend is exactly equal to the market rate, then it will be issued at face value. Okay. But now when it comes to the value of market value, so please remember we assume here preferred stocks are irredeemable. So in that scenario, we will apply the simple formula. Preferred stock have fixed amount of dividend, right? And that dividend is not growing. So in that scenario, I told you if dividend is constant from today, so how you calculate the market value or the present value? So you will take amount of dividend divided by investors' required rate of return. And here investors are preferred shareholders. So you have to take preferred shareholders' required rate of return. So this formula you will apply. So we'll assume dividend is constant from today to infinity. Okay, guys? From today to infinity. So this is a formula: dividend per share divided by cost of capital. Cost of capital means investor required rate of return, a required rate of return of preferred shareholders. Understood? So now, guys, I have a quick question here. For example, we have example. For example, several years ago, a company issued preferred stock that pays a fixed dividend each year of $12. So amount of dividend is $12. So we'll write it $12. $12 divided by cost of capital. Investor required rate of return 15%. So we'll take 0.15. If I will solve, so $80 will be your market value of stock. Now look at here another example. Company has issued 4%. 4% is the percentage of dividend. 1,000 preferred stock. 1,000 is the number of preferred stock with the par value of $5 each. Investor required rate of return is 8%. So what is the market value of stock today? So guys, you can see here dividend amount is not given, but face value is given and percentage of dividend is given. If you will take percentage of dividend multiply by face value, this will give you amount of dividend per share. So face value is how much? $5 into 4%. So this will give you $0.2 as a amount of dividend divided by investor required rate of return, which is 8%, 0.08. So if you will solve, you will get market value of much $2.5 market value per preferred stock. Understood? So now we are going to discuss some practice question. Please, it's not necessary that every time you will get simply straight away questions. So questions sometimes might be reverse also. So I'm going to show one question. For example, our corporation paid dividend of $3 per share last year. This is last year dividend. And investors expected that dividend per share to grow by 5%. This is growth rate per year forever. This is growth for infinity. What required rate of investor is consistent with the current share price of $63? So guys, see here, you are not required to calculate market value of shares. Market value of share is already given $63. Here you are required to calculate investor required rate of return. You have to calculate. And now you will apply the formula first. What was the formula? So market value equals dividend, last year dividend into 1 plus growth. This is last year dividend divided by investors required rate of return minus growth. This is the formula. And see the data, whatever is given, just right. So we have a dividend, last year dividend is $3. $3 into 1 plus growth. Growth is 5%, so 0.05. Divided by investors required rate of return, you have to calculate. Growth is given 0.05. Okay, so this is equals market value, right? This is the formula. So now just proceed with this formula. If you will solve numerator first, market value equals. So it is, if you will just solve this, 3 into 3 times 1.05. So it is 3.15. So 3.15 divided by investors required rate of return minus 0.5. Okay. And market value stock is given already. How much? 63. It's given. So now can you solve here? The further equation you can solve here. So now how it will work? So I'm just showing investors required rate of return minus growth, which is 0.05. This is 0.05. Okay. Because 5%. Okay. Equals 3.15 divided by market value. Market value is how much? 63, right? This equation I'm just solving. Now, how would you just solve 3.15? Now, again, this investors required rate of return minus 0.05 equals, just solve this side now. 3.15 divided by 63. It is 0.05. Now, again, I want investors required rate of return, which will be equal 0.05, and this minus will become plus a 0.05. And now investors required rate of return will be equal to 0.10. 0.10 means 10%. Okay, 0.10, if you will multiply with 100, you will get 10% answer. Okay, guys. So here you have to calculate investors required rate of return. I'm showing you one more similar question. So the answer would be 10%. Okay, answer would be 10%. For example, 10 years ago, perpetual preferred shares, it is preferred shares with the par value $50. This is the par value. And annual dividend rate is 6%. Okay, if I want to calculate amount of dividend, I'll take par value multiply by amount, multiply by percentage of dividend. This will give you amount of dividend. They say currently there are no dividend in arrears since the issue date. Interest rates have risen and shares are now selling at 38. Again, it's a market value. So market's current required rate of return. So you have to calculate current required rate of return. Means investor required rate of return. It's a preference here. So you will apply preferred share formula. Preferred share formula will be what? So market value will be equal to dividend into divided by investors required rate of return. How would you calculate dividend? Market value is given, right? Market value is given $38 here. And how you would calculate the dividend? So dividend you can calculate by taking face value, which is $50 into 6%. So this will give you dividend value. Okay, so $50 times 6%. It will be 3. So 3, now we can solve the formula. So now investors required rate of return will be equal to dividend, which is $3 divided by market, which is 38. So and again solve 3 divided by 38. So now we have a 3 divided by 38. So it is going to be 0. So investors required rate of return is going to be 0.789. Okay, if I'll just multiply with 100 to get the percentage, it will be 7.89%. Okay, so this will be answer B. Showing you one more question here, because it's also similar question. So guys, here we have to find out, for example, they're saying a corporation just paid a dividend of $2 per share. This is last year dividend, just paid, means a recent dividend. This for common share. Historical data indicate that dividend grow at the rate of 5% per year. Okay. The required rate of return in such stock is 18%. Okay. This is the required rate of return. The current market value of one share of common stock is current, means a today market value. It means you are applying formula that if dividend is growing from today to infinity. So what is the formula? Market value equals dividend, last dividend into 1 plus growth divided by investors required rate of return minus growth. Just apply. Dividend is $2. So $2 into 1 plus growth is how much? Where is the growth? This is the 5% growth, 0.05 divided by investor required rate of return is 18%, 0.18 minus 0.05. If you will solve, so you will get this answer. What will be the answer? 16.15. Understood? I hope so it is clear. This is what is all about stock valuation. Thank you so much. If you have any question, you can ask me.